Ray Dalio has predicted more major economic turning points than almost any investor alive. He called 2008 years before it happened. He called the dot-com collapse. He built a $150 billion hedge fund by doing one thing most investors refuse to do: looking at what is actually happening instead of what they hope is happening. And right now, he is saying something that every person with savings, a retirement account, or an investment portfolio needs to hear. Most of what people own today will not survive the next phase of this economic cycle intact. Not because the companies are bad, not because the ideas are wrong, because the environment is shifting in ways that most investors are not positioned for. Today, Ray Dalio names the only 5 investments he believes will genuinely protect and grow wealth through what is coming. Stay until the end. The last one will surprise you. Let's get into the video.
I want to start with something most financial commentators will not say out loud. The investment portfolio that has worked beautifully for the last decade, the one that felt diversified, felt sensible, felt like the responsible thing to own, is not built for what is coming next. It was built for a world of low inflation, falling interest rates, expanding credit, and unlimited faith in the ability of central banks to manage whatever disruption arose. That world is not gone, but it is changing. And the investments that thrived in it are not the same investments that will protect you through the transition. I have studied economic history across 500 years and dozens of countries. I have built models of how economies, markets, and empires rise and fall that Bridgewater has stress tested against every major historical precedent we could find. And when I look at where we are right now, the debt levels, the geopolitical fragmentation, the currency dynamics, the concentration of wealth, and the political consequences of that concentration, I see a template I have seen before, not once, many times, across many different economies, in many different eras. And the template is consistent enough that I feel a responsibility to share what it says, not to frighten anyone, not to generate clicks, but because the people who were positioned correctly when the template played out in previous eras kept their wealth, and the people who were not lost large portions of it, sometimes permanently. Let me show you the template first, then I will show you the 5 investments that survive it. The template, what is actually happening right now, the economic machine runs on a simple mechanism that most people understand when they study it, but forget when markets are calm and everything feels fine. It runs on credit, on the willingness of borrowers to take on debt and lenders to extend it, on the confidence that the debt will be repaid and that the currency it is denominated in will hold its value. When that confidence is high, when credit is expanding, when interest rates are low, when the economy is growing and asset prices are rising, almost everything works. Stocks go up. Bonds pay their coupons. Real estate appreciates. Cash savings earn a reasonable return. The rising tide lifts everything, and it becomes very easy to confuse a rising environment with investment skill. When that confidence begins to erode, when the debt load becomes too large, when the ability to service existing debt requires borrowing more, when the mathematics of the situation become impossible to ignore, the machine starts to strain. And in the straining, the things that worked in the good environment start to fail. Not all at once, not with a single dramatic event that everyone can point to, gradually. Then suddenly, we are in the gradual phase right now. And I want to be precise about why I believe that, because I am not asking you to take this on faith. The United States federal government is currently spending approximately $2 trillion more per year than it collects in revenue. It is financing that gap by issuing treasury bonds, borrowing from investors, from foreign governments, from the Federal Reserve itself. The total national debt has crossed $34 trillion. The annual interest payment on that debt has exceeded $1 trillion. That is more than the entire defense budget, more than Medicare, more than Social Security, just the interest, just the cost of carrying the debt that already exists. And here is the part that creates the most severe constraint. As existing debt matures and is rolled over at current interest rates, which are dramatically higher than the rates at which most of the existing debt was originally issued, the interest burden will continue to grow even if the government does not borrow a single additional dollar. The mathematics are not ambiguous, they are simply uncomfortable to look at directly. Governments facing this situation have historically had three options. They can cut spending dramatically, which is politically catastrophic and has historically been chosen only under extreme duress. They can raise taxes dramatically, which is economically damaging and also politically catastrophic. Or they can do what governments almost always choose when the first two options feel impossible. They print money, they devalue the currency, they inflate their way out of the debt by making each dollar worth less, so the real burden of the debt shrinks, even as the nominal number stays the same. This is the environment I am positioning for, not the collapse of America, not the end of capitalism, the specific, historically consistent, mathematically predictable consequences of a government that has borrowed more than it can honestly repay, trying to manage that situation through currency debasement. In that environment, which I believe we are already in the early stages of, most conventional investment portfolios will lose real value, not necessarily nominal value. The number on the screen may stay the same or even go up, but the purchasing power of that number, what it actually buys in the real world, will shrink quietly, consistently, in ways that do not show up in the daily price feed, but that become devastatingly clear over 5 or 10 years when you try to understand why your wealth did not go as far as you expected. The five investments I am about to describe are the ones that either maintain their real value in that environment or actively benefit from it. I have owned versions of all of them throughout my career. Several of them I hold today. Let me take you through each one and explain not just what it is, but why it specifically survives what is coming. Investment one, gold, the 5,000-year survivor. I have said this before, and I will keep saying it until people stop being surprised by it. Gold is not a relic. Gold is not a barbarous metal that has been superseded by modern financial instruments. Gold is the only monetary asset in human history that has survived every single debt crisis, every single currency collapse, every single empire that overborrowed and tried to inflate its way out. The reason is simple, and it has not changed in 5,000 years. Gold cannot be printed. No central bank decision, no government decree, no financial innovation can create more of it. It exists in a fixed, finite supply that is completely indifferent to the political and economic pressures that cause paper currencies to lose their value. Right now, central banks around the world are buying gold at a pace we have not seen in decades. China's central bank has been accumulating consistently and aggressively. India, Poland, Turkey, Singapore, the institutions that manage the monetary reserves of major economies, are quietly and deliberately increasing their gold exposure and decreasing their dollar exposure. This is not a coincidence. These are the institutions with the most direct visibility into the health of the global monetary system, and their actions are telling you something their public statements are not. When the people who print the money are buying the thing that cannot be printed, that is a signal I take seriously. I take it more seriously than any analyst report, any economic forecast, any piece of financial media I have ever read. Gold does not pay a dividend. Gold does not generate earnings. It just holds its value across time and across every form of monetary stress that human societies have managed to create. In the environment I am describing, currency debasement, debt monetization, declining faith in paper promises, that characteristic is not a weakness. It is the most important quality an asset can have. I believe every investor should have meaningful gold exposure right now, not a token 2% allocation that you can mention without actually feeling it if gold moves. A real position, one that would genuinely protect your purchasing power if the currency dynamics I am describing intensify over the next several years. Investment two, businesses with genuine pricing power. Not all equities will survive what is coming. Let me be very clear about that. The broad equity market, particularly the portion of it that is priced at extreme multiples based on optimistic growth assumptions, faces significant risk in a higher inflation, higher interest rate, slower growth environment. When the cost of capital rises, the present value of future earnings falls. When consumers are squeezed by inflation, revenue growth slows. When credit becomes expensive, the leveraged buybacks and acquisitions that have driven earnings per share growth over the last decade become less available. But within equities, there is a specific quality that historically survives inflationary environments far better than the broad market: pricing power, the ability of a business to raise its prices in line with or ahead of inflation without losing its customers. This is the moat concept that Warren Buffett has described so eloquently, but I want to frame it specifically through the lens of inflation survival. A business with genuine pricing power, one where customers are not price sensitive because they are dependent on the product, because the switching costs are high, because the brand carries emotional value that transcends the price tag, can pass inflation through to its customers. Its revenues rise as prices rise. Its earnings maintain their real value. Its stock price over time reflects the real value of those earnings. A business without pricing power, one where customers will switch to a cheaper alternative the moment prices rise, where competition is intense and margins are thin, where the product is a commodity with no differentiation, cannot pass inflation through. Its costs rise, but its revenues cannot follow. Its margins compress. Its earnings deteriorate in real terms. The distinction between these two categories of business matters enormously in the inflationary environment I am describing. And identifying businesses with genuine, durable pricing power, not the illusion of pricing power that exists in a bull market when everything works, is one of the most important investment exercises anyone can do right now. The companies I am thinking about are not necessarily the most exciting names in the market. They are often in industries that seem boring: consumer staples, healthcare services, infrastructure, businesses that provide things people need regardless of the economic environment, and that have built positions so entrenched that no competitor can easily undercut them. These businesses will not make you rich quickly, but in an environment where most portfolios are losing real purchasing power, a business that maintains and slowly grows real earnings is one of the most valuable things you can own. Investment three, hard assets that produce income. The third category that historically survives inflationary debt cycles is hard assets that generate income: real estate that produces rental income, farmland that produces agricultural output, infrastructure that generates toll revenue or utility payments, timberland. These are assets where the underlying productive capacity is real and physical. It cannot be inflated away, and where the income stream adjusts over time as prices in the broader economy rise. I want to be specific about why the income component matters. A hard asset that does not produce income, a vacant lot, a speculative land holding, benefits from inflation in the sense that its nominal value rises, but it gives you nothing in the meantime. You are simply holding and hoping. That is a different position from owning a productive hard asset where the income stream compounds year after year while the underlying asset also appreciates in real terms. Farmland is perhaps the clearest example of this. The world needs food. The amount of arable land is finite and cannot be meaningfully expanded. Population growth continues to increase demand, while climate change and development pressure reduce the available supply. Farmland in productive agricultural regions generates rental income from the farmers who work it, and that income adjusts over time as food prices rise. The asset itself has historically held its real value across every inflationary episode in modern history. I am not suggesting everyone needs to buy a farm, but the principle, real assets with real income streams that adjust with inflation, can be accessed through various instruments. Real estate investment trusts focused on productive properties rather than speculative development. Agricultural land funds, infrastructure funds, these vehicles provide exposure to the asset class without requiring direct ownership and management. The key distinction to make is between hard assets that produce income and hard assets that are purely speculative price plays. In a difficult environment, the former is a shelter, the latter is a bet. And I am not in the business of recommending bets right now. I am in the business of recommending shelter. Investment 4, international assets outside the dollar system. The fourth investment that I believe will survive and potentially thrive through what is coming is one that most American investors systematically underweight. And they underweight it not because of careful analysis, but because of familiarity. Because American markets have performed extraordinarily well for an extended period. Because investing in what you know and what has worked recently is always psychologically easier than diversifying into what feels unfamiliar. International equities, particularly in markets where debt dynamics are more sustainable, demographic profiles are more favorable, and valuations are more rational, provide something that a purely domestic portfolio cannot: exposure to economic growth stories that are not correlated with the fate of the American dollar. If the dollar weakens, which is what the debt debasement scenario implies, then assets denominated in other currencies gain relative value for dollar-based investors simply from the currency translation. A portfolio that is 100% invested in dollar-denominated assets gets no benefit from this dynamic. A portfolio that includes meaningful international exposure participates in it. I am thinking specifically about certain Asian markets where the long-term growth story remains intact, where government debt levels are more manageable, and where the structural trends, rising middle class, technology adoption, infrastructure development, are powerful and durable. I am thinking about commodity exporting economies that benefit directly from the rising price of real assets. I am thinking about markets where equity valuations have not been stretched to the same extremes as American markets, and where the risk reward for patient long term investors is meaningfully more attractive. This is not about abandoning American investments. It is about recognizing that concentrating everything in one currency and one market, regardless of how strong that market has been recently, creates a correlation risk that is not consistent with genuine diversification. When the variable that could hurt your portfolio most is something that affects all dollar denominated assets simultaneously, owning 100 different dollar denominated assets does not actually protect you. Real diversification means owning assets whose fortunes are not all determined by the same underlying factor. International equity exposure is one of the most direct ways to achieve that. Investment 5, yourself, and this one will surprise you. The fifth investment that will survive what is coming is the one that most people overlook entirely when they think about portfolio construction. and it is also the one that has historically provided the highest returns of any asset class to the investors who made it seriously and consistently. Yourself, your skills, your expertise, your capacity to produce value in the world. I know this sounds like something you put on a motivational poster rather than something a hedge fund manager says in a serious discussion about portfolio construction. But I mean it with complete seriousness, and I want to explain why, in the specific environment I am describing, this investment is more important than it has been at almost any point in recent history. In an inflationary environment, in an environment where the real value of financial assets is being eroded by currency debasement, the most reliable store of value is the ability to generate income, not passive income from assets that may or may not hold their value. Active income from skills and expertise that are genuinely scarce and genuinely valuable. Income that rises with inflation because the market for your skills adjusts to economic conditions. Income that is not subject to confiscation or devaluation because it lives in your head and your hands rather than in a financial account. The return on investing in your own human capital, in becoming genuinely exceptional at something the world needs, is not measured in percentage points per year. It is measured in the trajectory of an entire career, in the difference between a person who can be replaced by the next available candidate and a person whose specific knowledge and capabilities are so valuable that the market competes for them. I invested heavily in myself in the years before Bridgewater generated meaningful returns. I read everything I could find. I studied the history of economies and markets with the same intensity that I later applied to managing money. I built analytical frameworks that I tested and refined through real experience. That investment paid returns that no financial asset could have matched, and it paid them consistently across every economic cycle I have subsequently lived through. The specific skills that will be most valuable in the environment I am describing are the ones that help people navigate complexity, financial literacy, economic understanding, the ability to assess risk and construct resilient systems, technological capability in domains that are genuinely transforming industries, the ability to create and communicate ideas in ways that reach and influence people. These skills will be in demand regardless of what interest rates do, regardless of what the dollar does, regardless of what the stock market does. The most important thing you can do is to invest in yourself. The more you learn, the more you earn. In a world where financial assets face the kind of headwinds I have described, where currency debasement erodes real returns, where debt dynamics create structural constraints on growth, where geopolitical fragmentation disrupts the global trading relationships that powered the last several decades of prosperity. The investor who has also built genuine human capital is doubly protected. Their financial assets provide what protection they can. Their human capital provides income and value creation that is not dependent on the financial environment at all. This is the investment most people make too little of too late and stop making too soon. They invest in their education early, then stop when they feel competent. But the world does not stop changing when you feel competent. And the skills that made you valuable yesterday are not necessarily the skills that will make you valuable in the environment that is coming. Keep learning, keep building, keep compounding your human capital with the same consistency and patience that you apply to your financial capital. Let me bring these 5 investments together into something practical, because I am not interested in abstract frameworks. I am interested in what people should actually do. The portfolio I am describing is not complicated. It is not exotic. It does not require access to hedge funds or private placements or sophisticated derivatives. It requires diversification, across the specific types of assets that have historically preserved and grown real wealth through the kind of environment the template is pointing toward. Meaningful gold exposure, not a token position, but a real one. 5 to 15% is a reasonable range for most investors, with the higher end more appropriate for those most concerned about currency debasement. Physical gold where possible, ETFs where physical ownership is not practical. Equity exposure concentrated in businesses with genuine pricing power rather than the broad market. Not every stock in the index. The specific companies in consumer staples, healthcare, infrastructure, essential technology, where the competitive position is so strong that inflation can be passed through to customers without losing them. Hard productive assets, farmland, income generating real estate, infrastructure, either directly or through vehicles that provide exposure without direct management. The income matters as much as the asset appreciation. International diversification away from pure dollar concentration. Emerging markets with strong fundamentals, commodity exporters, Asian growth markets that provide exposure to economic stories not entirely dependent on the health of the American currency, and consistent investment in your own expertise and capabilities. Whatever that looks like for your specific situation, courses, mentors, deliberate practice, exposure to ideas and people at the frontier of your field. The compounding on human capital investment is as real and as powerful as the compounding on financial capital. It just shows up differently. This is not a prediction. I want to be clear about that. I cannot tell you exactly when each phase of what I am describing will arrive or exactly how severe each disruption will be. The template tells me the direction. It does not give me a calendar. What I can tell you with confidence, the confidence that comes from 5 decades of studying how these cycles play out across how many countries and how many eras, is that the investors who are positioned in these 5 categories when the next phase arrives will look back on this period and feel they made the right decisions. And the investors who stayed concentrated in the assets that have performed best in the environment we are leaving will face a far more difficult reckoning. The window to prepare is always narrower than it feels when you are comfortable. It always closes before people expect it to. And the cost of acting when the window has already closed is always higher than the cost of acting now while the environment still feels manageable. Position now, not because crisis is guaranteed to be imminent, because the cost of being prepared for something that arrives later is small. The cost of being unprepared for something that arrives sooner is everything. The machine does not wait for you to be ready, it just moves. And the only investors it rewards are the ones who moved first.
5 investments: gold, businesses with pricing power, hard productive assets, international diversification, and yourself. That is the list Ray Dalio believes will genuinely protect and grow wealth through what the economic machine is telling us is coming next. Your action this week: look at your portfolio against those 5 categories. Not to panic, not to sell everything tomorrow, just to honestly assess how positioned you actually are for an environment that looks different from the last 10 years. Let me know what you are doing to prepare for what is likely coming in the next 18 months. Leave it in the comments below, and as always, I will see you in the next video.